So in 2023, the ETF of the S&P 500 would have earned a total return of 26%. So you could have done absolutely nothing and earned a 26% return in 2023. So
just as an aside, that's absolutely crazy.
that is
26% a year from an ETF. Holy smokes!
Yeah. It's not been a bad year to just be a passive investor.
Yeah,
it's a pretty significant increase in your net worth if you have a good chunk of it, continually investing in an ETF. But how do they compare to the fund managers? The professional investors, of course, they would have done significantly better than that, right?
The professionals would have. Of course, they're professionals.
Yeah,
I mean, it's their one and only job.
Yep.
To manage other people's money and other people's investments and perform better than what the average Joe can do by investing in an ETF.
Yep, exactly.
Am I wrong?
No,
that's their job, right?
Yep, you're not wrong at all. So the Wall Street Journal did a survey of 1,191 investment funds in the US. It was a survey of actively managed US funds with more than $50 million in assets under management and a track record of at least 3 years. They excluded leveraged funds, so no using leverage, no indexes, and no sector-focused funds. So a sector fund focused on like renewable energy or something, for example. And it also excluded most quantitative funds, so most quant funds. So that was kind of their survey. The S&P, as I said, up 26%. It was actually mostly driven by 7 companies that have now been coined the Magnificent Seven. So Amazon, Nvidia, Tesla, Microsoft, Google, Meta, and Apple. Without those 7 companies, the S&P would have been up 9.9%, which is still a very good year. But more than half of the gains in 2023 were driven by 7 companies that all have kind of AI-related projects or are seemingly going to benefit in some way from some kind of new technology boom.
It's pretty insane when you think about it. There's obviously 500 companies in the S&P 500, and of the total increase of the 500, 60% of that increase came from just 7.
Yeah,
just 7 of them.
Yeah,
that's mind blowing. It shows you how much, how top heavy that S&P 500. It's crazy.
Yeah.
It's crazy. Anyway,
so
sorry, mate.
It should be no surprise that the investment funds that did best were mostly funds that had a large cap growth stock strategy. So they mostly had big companies that had a focus on growth, like the Magnificent Seven, for example. 9 out of the top 10 performers were in Morningstar's large cap growth category. So that should be absolutely no surprise given how the year panned out. All right, so let's look at some stats from the year for investment firms. 1,000 of the 1,191 firms surveyed returned more than 10%. So most of the funds did double-digit returns, which is obviously good.
That's actually all right.
The average return was 19.7%, so an underperformance of 6.5% percentage points than the
That's
ETF.
Not so good.
Yeah, so the average of these funds not too good. And my presumption is this is before fees as well. So, that's something to kind of consider. Only 4 firms surveyed were negative in 2023. So I don't know who they were, but
they sucked.
Yeah, they're not good. No.
I don't know who they are, but don't invest with them.
No. The winner was a fund called Virtus Zevenbergen Innovation Growth Stock Fund. They were up 65.2% in 2023, although it was after a negative 55 in 2022 and a negative 10% in 2021. So they are up, but if you'd been investing with them for a couple of years, you're not doing too hot.
No.
So
they've turned your $100 into $1, and now they've just turned the $1 into $2.
Yeah, exactly.
Well
Gold medal.
It's amazing. Yeah. We've doubled your money.
Yeah. They'll probably get an influx of clients as well this year from their great performance.
Yeah, probably. Yeah, actually though.
Yeah.
So funny, isn't it, Hamish?
It's ridiculous. Virtus held 5 of the Magnificent Seven stocks. So that's no surprise there. Tesla was the fund's biggest position, 7.7% of the assets. Other big portfolio winners was Mercado Libre, which is a Latin American e-commerce giant, up 86%, and Shopify up 124%. In second place, Value Line Larger Companies Focused Fund, it's a bit of a mouthful, they held all 7 of the Magnificent 7 companies. So again, there's a bit of a trend here. If you held the Magnificent 7 companies, you did pretty well. So that's kind of no surprise there. They were up 59% in 2023. So another obviously very, very good year. The only fund in the top 10 that wasn't large cap focused was Morgan Stanley's Inception portfolio. This is a small cap portfolio. And they were up 54% in 2023, so in 5th place, despite the small cap index only rising 17%. So that's a kind of an interesting one, but that's the only fund in the top 10 that wasn't focused on large cap companies. So there you go. But
there you go.
All in all, based on the average
they
return,
underperformed.
Yeah, but all in all, yeah. I wish they had some stats on specifically kind of how many how many underperformed. But we don't get those details, unfortunately.
Yeah. Honestly, if there's one bet that I would be happy making, I'm not a betting man, but if there's one bet that I'd be happy making, it's that the vast majority of actively managed funds will underperform the stock market.
Yep.
That is one thing that I would happily bet on any day of the week.
Yeah.